Welcome to Bit by Bitcoin. It's your host, Dylan Loomis. First up today, we have the latest with regard to FinCEN's newly proposed rule that would require crypto exchanges to gather more personal data from customers, transferring more than $3,000 worth of crypto into private wallets. Throughout these news episodes, I'll do my very best to get the most important information into 10-minute packages and to educate everybody on certain topics and buzzwords if you're new to the space. FinCEN is short for the Financial Crime Enforcement Network, a unit of the United States Treasury Department, not to be confused with fintech, financial technology companies like Square, PayPal, Robinhood, and others. The last few days have been opened for public comment, and many big names in the industry have been pushing back on this proposed rule. It could lead to crypto innovation happening outside of the US borders, and it would also threaten some of the digital privacy rights of people transacting with cryptocurrency. Over 65,000 comments were submitted, including some from Square, the US Chamber of Commerce, and Coinbase, and they were attempting to delay these new rules to avoid a hasty action that could have some serious unintended effects. And just so you know, the Treasury Department refers to crypto that's convertible to fiat as convertible virtual currency, or CVCs. Here's what Twitter's CEO Jack Dorsey had to say on this proposed rule. The incongruity between the treatment of cash and cryptocurrency under FinCEN's proposal will inhibit adoption of cryptocurrency and invade the privacy of individuals. Yet the rule fails to explain the difference in risk. As such, this low threshold and its extension of KYC obligations beyond customer relationships is arbitrary and unjustified. KYC stands for Know Your Customer. So basically, with this rule, FinCEN is trying to require these exchanges to provide more data than they require for typical cash transactions. If this rule is ultimately finalized, it would most likely be challenged in court because the time frame for commenting on the proposal was shortened from the typical 60-day comment period that's required. And there is an argument to be made that providing this customer data to FinCEN would also be detrimental because FinCEN's files were leaked and the Treasury Department systems were breached very recently. And so customers would actually be safer using personal wallets, privacy coins, and other financial tools that are free from government surveillance and interference. In that attack, 18,000 individuals were compromised. If FinCEN had customers' personal data like home address and other KYC info, hackers could surveil crypto users' activity by associating their public addresses for these wallets with the users' names and locations. So we'll see how this one plays out. Bill Miller gave us some new comments in support of Bitcoin, confronting Warren Buffett's famous "Bitcoin is rat poison" statements. Bill Miller is a hedge fund manager and the founder of Miller Value Partners. And to bring you up to speed, in 2019, when many actively managed funds were struggling to post double-digit returns or even really keep up with the S&P 500, Miller's hedge fund returned 120%. This is 2019, not 2020. The S&P 500 was up 30% in 2019. Miller also said that the bull run was going to continue into 2020 for the stock market, and that it did. In his Q4 letter to investors, he mentioned how Bitcoin has outperformed all major asset classes and how the market cap of Bitcoin had surpassed that of JP Morgan and Berkshire Hathaway. As of the recording of this episode, Bitcoin has a market cap of $735 billion. But back to Warren Buffett real quick. He called Bitcoin rat poison, and Bill Miller chimed in saying he may well be right. Bitcoin could be rat poison, and the rat could be cash. He also cited that the corporate balance sheet conversion is just getting started, with companies like MicroStrategy, Square, and MassMutual all moving cash into Bitcoin. So to have a traditional investor like Bill Miller come out and be so vocally in support of Bitcoin to his investors is certainly worth noting. Next up, statistics from On-Chain show that 78% of the circulating Bitcoin supply is illiquid and barely accessible. That means that about 14.5 million Bitcoin is illiquid, leaving only about 4.2 million Bitcoin in constant circulation. So one of the best parts about the Bitcoin protocol is that the system is mathematically provable and the Bitcoins are scarce. When Satoshi Nakamoto, the pseudonymous founder of Bitcoin, created the asset, the inventor set the supply to cap at 21 million coins ever to be issued. It's technically 20.9999 million, but more on that in a later episode. As of today, there's roughly 18.58 million Bitcoin in circulation, with the remainder to be mined in the coming years. But the takeaway here is that with this statistic that 78% of the Bitcoin is illiquid, aka being hoarded by long-term investors, this creates a very bullish sentiment and reduces any downward selling pressure, and it also limits the truly available supply. And as I mentioned, large institutions and fund managers have been purchasing Bitcoin, many of them behind the scenes and as quietly as possible. If you take a look at the Bitcoin Treasuries list, we see MicroStrategy leading the way with about $2.8 billion worth of Bitcoin on their company's balance sheet. The Bitcoin Treasuries list has grown quickly this year, with 29 well-known companies securing 1.1 million Bitcoin to be held for their treasury reserves. In terms of the exchanges, Coinbase is the leading exchange with 870,000 Bitcoin on hand that are liquid for trading. Next up is Huobi with 252,000, Binance with 215K, Bitfinex with 142K, and Kraken with 137K. And to wrap up today's episode, Bitcoin did cross the $40,000 threshold earlier today, which helped move the market cap of the entire cryptocurrency market above $1 trillion for the first time. Bitcoin is up over 30% from the start of 2021 and is up 400% in the past 12 months. Our favorite venture capitalist, Chamath Palihapitiya, said, quote, "It's probably going to 100,000, then 150,000, then 200,000. In what period? I don't know, maybe 5 or 10 years, but it's going there." The reason it's going there is because every time you see all of this stuff happening, it reminds you that our leaders are not as trustworthy and reliable as they used to be. So just in case we really do need to have some insurance we can keep under our pillow that gives us some access to an uncorrelated hedge. The thing is, now Bitcoin is transitioning from what used to be a contrarian idea or trade to a consensus trade. That's partially where this price discovery and repricing of Bitcoin comes from, as more people decide they want exposure and they see the technology as more than just a hedge to inflation of fiat currencies. I have a video coming out that will nuance the relationship between inflation and Bitcoin, as that relationship is far more complex than most people think. So be sure to subscribe for that one. But that's going to wrap it up for today's Bitcoin news segment. Please let me know if you have any questions below. Take a moment to like the video if you did, and I look forward to seeing you in the next video. I hope that you have a great day.